Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. We're looking for potential multi-baggers, potential stocks that can go up hundreds or even thousands of percent over time. That's the goal of what we're looking for, exceptional companies that can compound and grow over time. Yeah, the stock price might go like this, but what's the underlying business fundamentals doing quarter to quarter, year to year? That's what we're focusing on, trying to find those exceptional businesses. And a lot of folks were asking about, hey, could Transferwise, or Wise Stock as it's been subsequently rebranded, could Wise be part of that investment journey that could deliver exceptional growth in the years ahead? And my answer is quite possibly. I like their value proposition. I like what they're doing. They're tackling a big market. The tricky part is their valuation. We'll talk a little bit more about that at the end of this video. And, just a quick recap to understand how we think about things. We're looking for unrivaled companies. We're looking for companies that are exceptional and have the right to win because they're doing something better than most of the competition. And so when you have something that's either really strong value proposition or unrivaled, it means there's a greater chance that you could grow at a good clip over time. So that's what I'm focused on here. Let's dive into Wise stock. And so to understand Wise, one should first understand, okay, so this trades on the London Stock Exchange as Wise, but you can also buy the US ADR as WPLCF. This is Wise, otherwise known as Transferwise for a lot of folks that are more familiar with the brand over a few years. And so what are they doing? So you're talking about an international money transfer business, going from one country to the next, peer to peer, or sending it from person to person across borders, is a £2 trillion business. This is a huge business. Everything here is priced in pounds just because Transferwise is a British company, founded by a couple of Estonians. And then if you look at business to business transfers, now you're looking at something like £7 trillion. So either way, you're talking about huge figures that they're tapping into. And then when you look at small and medium sized business, then it's, so small and medium sized, 7 trillion, enterprises, 9 trillion pounds. All in, you're looking at like 18 trillion in global cross-border payment market volume. And this market's expected to keep growing, either with inflation, more money printing, so that they're saying, look, cross-border payment volume is still expected to grow 4 to 5% a year to get to 24 trillion pounds in the years ahead. So not only are you tapping into a large market, but you're also tapping into a market that's growing at probably GDP plus a little bit. Now, here's where Wise comes in, where they recognize that legacy bank fees in terms of transferring funds from one country to another adds up a lot. Where currently there's about 180 billion pounds of fees. That's the annual cost for the world to move money internationally. That's a lot of friction. That's a lot of costs that these banks are just effectively collecting. And they're sort of saying, well, wait a second, there should be a new changing paradigm for what people want about better customer service, instant transfers, and where customers are effectively saying, hey, I don't need to go with this legacy domestic bank that might charge me an arm and a leg. What if I can get better service, better customer service, better transferring, where it costs less in very short order? So maybe I'll go with a non-traditional bank like Wise, where maybe that's where I'm going to keep a good chunk of my funds to take care of my expenses. And so this is a changing paradigm. And on average, their fees are up to 8x cheaper than traditional banks. So they're aiming to be effectively the low-cost player. And they even talk about the idea of effectively having no fees in the future. So they keep pushing down their fee costs. Now, their average fee currently is around 0.4% to around 0.7%. If you know more about Transferwise and you have a take on how they could ultimately push their fees down to zero, I'd love to hear your thoughts. I suspect it might have to do with effectively getting interest on their float. Now, that wouldn't work in a no interest rate environment like we're currently in, but if you were to have a much higher interest rate environment in the future, it's possible that they could even lower their fees further, really crushing a lot of these banks from a fee perspective, and just get interest rate off of the float with the capital that people effectively have with their Wise accounts. That's, I think, the direction where you're heading over a multi-year perspective, and ultimately what could make them even more competitive. But either way, their average fee per transaction, per transfer, really, you're looking at about 0.5% all in. And they, that not only is that 8x cheaper than a lot of these banks, but it's arriving instantly. 38% of the time it's instant. More than 80% is under 24 hours. So if you need to make sure, you have family back home in a different country and they need to get that money soon, you have greater confidence. Or if you're a business and you say, hey, I need to pay my supplier, I need to pay this vendor, and they're, they provided a service in a different country, I need to make sure that they're paid, transferring it into the appropriate funds, here it is, you can make that happen instantly, 40% of the time, instantly. And you compare Wise versus traditional banks, and it's just easy to see why they're stacking up and why they're winning. And they talk about, hey, look, we're cheaper than traditional banks, where the traditional bank fees strikes is just completely ridiculous. From 3 to 7% is the average fee. They're very slow, traditional banks, 2 to 5 business days versus 62% under 1 hour, 83% under 24 hours. Very convenient. Effectively, this is effectively an app-first business. A few clicks on your phone, a few taps on your phone, versus the inconvenient, unfriendly customer interface that you might have to do with the traditional bank. Some traditional banks, you have to fill out paperwork. You have to actually go into the bank. Depending where you are in the world, transparent. It's very clear what are their fees, what exactly are they charging. Whereas with banks, it's a lot less clear. It's more of a pain. So you're looking at a huge market and a winning value proposition. And it's not surprising to see that 1 in 40 pounds of the 2 trillion pound personal cross-border volume is actually Transferwise now, which is about 2.5%. And so when you see a player like this launched just a few years ago already have starting to capture some market share, it does make you think, oh, could this be 5, 10%, 20% in the future? Absolutely, this could be much bigger. And part of the reason why is because, look, customers are satisfied with it, with a net promoter score of around 76. So the vast majority of customers are saying, hey, I would recommend this to others. And as a result, you have a significant amount of word of mouth spread, 67%. So that means you effectively leverage your sales and dollar spend, because you don't have to spend as much on sales and marketing to get new customers, because they're effectively saying, hey, people are so happy about this. Yeah, they're good. It's going to spread. People are going to say good things about you because of the value proposition you're bringing. So that almost becomes an advantage. And not surprisingly, more customers growth, and you can see their active customers growing, from 3.3 million to 6 million, drives more volume across their platform, which drives more revenue. And their revenue hasn't grown as quickly in some cases as their volume. Sometimes it has, but in some years they actively push back on their fees. Now here it is, it's actually grown in line or slightly quicker, but in some years they say, hey, our focus is on making sure our value proposition just keeps increasing. And that's music to my ears. I want to hear that your value proposition keeps increasing. And so they lower their fees over time to make them really stand out. And management expects to continue to grow at 20% plus in the years ahead. So they fully expect, hey, we're only at low single digit market share in personal transactions from a enterprise, small and medium businesses. We're really tiny. So this is a multi-year, potentially even multi-decade runway for them to grow. And they also talk about, I didn't post it here, but they also talk about how not only are they cheaper than domestic banks, they're also cheaper than PayPal, which is multiples of their size. And so as they've gotten bigger, they're looking to build out more functionality, such as direct integration with businesses. That way it's easier to, let's say, link up your expenditures with, let's say, an accounting program like Xero, or easier to pay expenses with like debit cards, or have effectively a bank account. So they're increasingly leaning in to improving their value add, not only with lower fees, but increased functionality. And so this goes back to the question of like, well, how can they do all of this? Like, how is it possible that they can have this lucrative business model, reinvest in all this sort of stuff? How is it possible that they're so much cheaper than the traditional banking system? And that's where it's worth understanding, oh, okay, the traditional banking system is about a correspondent banking system, where it's about sending money from the sender's bank. This is a case of example. They're doing a side-by-side comparison of, let's say, sending money from the US to Thailand. And so you'd have the sender's bank to a US correspondent, to an international correspondent. Then that international correspondent said, oh, okay, we got to make sure we send these funds to this Asian correspondent. And the Asian correspondent will find their Thai correspondent, and then they'll pass the same funds to the recipient bank. So it's like the funds are getting moved around from step to step to step, and each of these folks need to get paid along the way to make sure, hey, this works correctly. And that's a lot of mouths to feed, that's a lot of hands, and so that's part of the reason why this correspondent banking system is so much more expensive versus Transferwise, where it's effectively saying, hey, the sender's bank to Wise US Bank, Wise looks at it, says, oh, okay, this makes sense, then their bank directly sends it to the recipient's bank. So you're removing a lot of these intermediaries that you simply don't need, and that's really the core understanding of why they're able to offer these services at a fraction of what the legacy banking system has. It's effectively saying we don't need all these steps. Let's just try to keep it inside the Wise platform. And ideally, they're trying to create direct connections with the local payment system. Maybe it's a central bank, the local core bank. And you can see as, they effectively have different views where one is, hey, are we transferring money through a local financial institution, or does Wise have their own banking license, or, do they have a direct connection to the local payment system? And as you get more functionality, as Wise gets more functionality, they can do more things like having a debit card available, or having specific local features, or making it easier for you to transfer funds, or just deeper integration, making it cheaper and lower fees for these different countries. So this is, their view is, hey, let's get more and more deeply integrated into as many countries as we can, so that way we can, maybe that's through a banking license, or maybe that's a direct connection with, the central bank. Let's get these costs as low as possible, so that way consumers, businesses don't have to pay as much on this effectively transferring money from one country to the next. And so then the next question is, well, what about the valuation? Here I'm going to do a quick plug, where if this is your first time tuning in, my name is Daniel, you're watching Unrivaled Investing. We're looking for potential multi-baggers. If you want to follow my personal journey as I call out potential multi-baggers, see what I'm buying each month, buying and selling. I have weekly updates. First week of the month, I call out my full portfolio, talk about my top positions. And during the month, I call out at least one potential multi-bagger, type of stock that I think does have significant upside. I'm looking for asymmetric risk reward, and just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey, check out unrivaledinvesting.com. Let's go back to Transferwise to understand what's going on with Wise. And so as we look at their valuation, it's currently around 930 pounds, and so it's about $9.3 billion pound market cap, and that's grown. Their revenue has grown significantly over time. 70% growth in 2020, nearly 40% growth in 2021. I'm penciling out growth of, let's say, 25 to 35% in their fiscal 2022. This is their fiscal year, so that can be slightly different than their calendar years. And then what do I think their long-term profit margins could look like? Now, they're profitable currently, but they're not at this level of profitability. They're not yet fully at this optimized margins, and this is what I think they could potentially do at maturity. So I'm saying hypothetically you're at somewhere between 25 and 35% operating margins, and slap on some sort of tax rate. And if you're effectively trading at maybe 60 to 90 times earnings, 60 to 90 times earnings for a company that's growing, let's say 25 to 35 times, 35%, doesn't strike me as super cheap. You're effectively looking at this ratio of pro forma earnings, assuming full optimized margins, to growth that, this price to earnings to growth just doesn't strike me as super compelling. What I really like to see is when it's trading at like 1 times or under. Then I'm like, oh, okay, there's something super interesting here. But, they might have a lot of growth in the years ahead. They might be able to continue with 25, 30, 35% growth in the years ahead. So that's what I pencil out for the ensuing 4 years. What's the end multiple for, let's say, 4 or 5 years from now? And then, maybe 20 to 35 times multiple, depending on what their growth rate is over the ensuing years. And so based on that sort of range of assumptions, where you're talking about, let's say, 25 to 35% growth, 25 to 35% operating margins, and 20 to 35 times, end multiple, it's all very similar growth rates and multiples that I'm looking at here. And look, if you have different assumptions, I'd love to hear it, how you think about it. So leave a comment below. But, the way I'm looking at this type of business, I'm just not super compelled by the valuation at this point, where, I'm effectively saying, hey, about 100% upside over the next 5 years versus about 50% downside over the ensuing 5 years. So it just doesn't strike me as, yeah, this is super compelling. Now keep in mind, this is a hypothetical framework. Of course, stock prices go way higher or way lower, but this is just how I'm thinking about it. It strikes me as the valuation being a bit rich for, very, very strong growth. It is strong, company with, a strong value proposition. It is taking share. Those are the things I like to see. It does have some optionality as they increase offering new services. So there's a lot that I like here. I'm just not quite sold on the valuation at this point. And it's okay. You don't have to pull the trigger right now. If you've pulled the trigger, I'd love to hear more of your personal thoughts in the comments below. And so this is something that I'd like to watch. I'd like to see how they execute over the years ahead. There's a good chance that this becomes a story that you watch, you see how they execute over a few quarters, and then maybe you pull the trigger down the road as maybe you get a better valuation, or maybe their growth rate turns out better than expected, or they offer new services that increase their value proposition. So there's a lot of different ways over time to potentially win, but you don't always have to swing just because you like the story. You can wait for the valuation to also come in, because every stock is driven not only by fundamentals but valuation as well. A lot of folks have lost sight of this over the last few years because valuations have just gone bananas, and sometimes valuations also contract. And if valuations contract, you can have a period where your fundamentals are doing real well, but if the valuation contracts, your return effectively goes nowhere as these two wash each other out. So you want to try to find things where you get a win from both over time. And so that's my take on Wise stock. Wise on the British exchange. You also have the US ADR, which I mentioned previously. And ultimately, I think there are just better plays out there. I've called several of them out to my Unrivaled Nation at unrivaledinvesting.com each month, calling out a potential multi-bagger. In July, for example, I called out a healthcare play that's growing very, very quickly, growing at multiples of Wise, yet it trades at a fraction of what Wise trades at, where Wise trades at, let's say, 16 times sales, and this healthcare play trades at like 3 times sales. So that's an example of this is a huge difference. And even when you factor in what long-term profit margins can look like, it's still a huge disconnect when you're looking at their growth prospects versus valuation. And that's the type of thing that I'm thinking about. A few months ago, I called out a company trading below liquidation value that I think over time could be 2 to 3x higher over time. So that's how I'm looking at trying to think about asymmetric risk reward. So if that's something that you might be interested in, go to unrivaledinvesting.com. If you've enjoyed learning about Wise, their business, their stock, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.